Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about the latest stock market news updates that you need to know as an investor. So for more videos just like this one, don't forget to go and annihilate that like button right now, subscribe if you are new, go ahead and become a member of this channel for as little as 99 cents per month because that's what keeps me here on YouTube, and with that being said, let's get right into today's stories. If you recall from our previous news updates, you know that the stock market has been struggling to make sense of lukewarm inflation data, which has radically impacted the market. We see the Nasdaq and the S&P 500 reporting less than impressive results and even Bitcoin trending downwards, despite the news of spot Bitcoin ETFs, which should have caused the cryptocurrency to rise. But since we're in earnings season, let's talk about some heavy hitters, including Microsoft and Apple, not necessarily in regards to their earnings, but rather how Microsoft recently dethroned Apple as the most valuable publicly traded company. But what other stock news updates do we have? Well, for starters, we have Microsoft temporarily becoming the most publicly traded valuable company in the world. Microsoft recently traded at $2.9 trillion for their market cap, which briefly edged over Apple's $2.89 trillion market cap, making Microsoft the more valuable company. However, shortly after Microsoft dethroned Apple, Apple then took it right back. However, I think this indicates that the tables may be turning for these longtime rivals. We also have to remember back in 1997, Microsoft actually saved Apple from going bankrupt. That's when Microsoft invested $150 million into Apple just to keep them afloat, to where Steve Jobs even called Bill Gates personally to thank him for the lifeline. We also see investors flooding into Microsoft, increasing their overall share price by 63% compared to Apple's 39% increase over the same period, according to the Wall Street Journal. So clearly, Microsoft is winning this battle, at least right now, between Apple and Microsoft to determine who is the better technology company. While Microsoft is gaining in popularity and technology, we actually see Apple slipping because they are facing slower demand for their iPhones over in China. But that's not all. Thanks to Microsoft's huge investment into OpenAI, this has allowed OpenAI to integrate themselves and produce more GPT type of products. For instance, OpenAI opened their ChatGPT store this week, where subscribers can create, browse, and use customized ChatGPT-powered bots. The best part about this, like I said in the last video, is that there is no coding experience required to make your own bot. As of right now, there has been over 3 million custom chatbots that have been created, and bot creators will also be rewarded based on the amount of engagement that they can get from the community. However, as of right now, only subscribers to the $20 a month ChatGPT Plus service will be able to access this store. Essentially, OpenAI, with the investment from Microsoft, is able to create a ChatGPT store where various people in the community who are subscribers can go in and use these ChatGPT bots. The good news, however, is the ChatGPT store could encourage more signups for their paid subscriptions, which will help OpenAI turn this into a moneymaker. The dream here is for the ChatGPT store to eventually start making loads of money, similarly to the Apple Store or Google's Play Store. And this ultimately is going to reflect very positively back on Microsoft's initial investment inside this company, which could further put them ahead of Apple. We also see other major tech companies laying off a swath of employees. For instance, Google laid off hundreds of workers to slash costs as they further invest into artificial intelligence capabilities. This is the latest news update in a series of various layoffs from companies like Amazon, Duolingo, as well as BlackRock. On the other hand, we have companies such as KB Home Shares, which are plummeting today as the US homebuilding giant said its profit margins would shrink this year. And this is not good news for investors who are invested into this company, particularly for its dividend. But as interest rates continue to stall and eventually come down, we should actually see the home market start to heat up. The good news for this company is that KB Home has experienced a surge in demand of new home orders, which tripled from the amount that they had last year. So right now could be an exquisite time to invest into real estate type companies and stocks. Now, despite the layoffs that we saw over at Google, Amazon, Duolingo, and BlackRock, we also see BlackRock making major moves. If you didn't know, BlackRock recently beat expectations for their earnings report, and they are one of the largest, if not the world's largest money managers. They recently saw its total top assets come in at $10 trillion in the fourth quarter of 2023. BlackRock reported earnings of $9.66 per share, and they also brought in revenue of $4.63 billion for the quarter. This beat expectations because analysts who were surveyed by FactSet actually anticipated the company to bring in only $8.84, but instead they brought in $9.66, which was a huge beat, which is phenomenal for investors. And if you already don't carry BlackRock in your portfolio, I would highly encourage you to look further into this company because, like we said earlier, they are the world's largest money manager. What's also interesting is that while other money managers have suffered outflows of cash recently, BlackRock said that its iShares exchange-traded funds enjoyed $186 billion in net inflows last year. This communicates to us that while investors are pulling their money out of other money management firms, they are very confident in BlackRock's ability to give them solid returns. So they are taking their money out of one institution and pouring them into BlackRock, which is great news for this company. We also saw BlackRock in the news because they recently bought Global Infrastructure Partners in a deal worth $12.5 billion. This deal is expected to close in the third quarter, and the deal is comprised of $3 billion worth of cash and 12 billion shares of BlackRock common stock, which recently closed at a price of $792.61 per share, so there's a lot of positive news surrounding BlackRock. Speaking about money managers, we also saw that Cathie Wood recently spent $25 million on Tesla stock. Cathie Wood, who is a manager over at ARK Invest, who's also their CEO, recently purchased Tesla when Tesla's TSLA shares dropped below their 200-day moving average. The reason for this drop in Tesla's share price is because Tesla recently announced a decision to cut their Chinese electric vehicle prices for their Model 3 and 2 Model Y variants. Cathie Wood then used this as an investment opportunity by purchasing 112,475 TSLA shares. And based on the recent closing price when she bought these shares of around $227.22, that would mean that Cathie Wood spent approximately $25.56 million on this Tesla purchase. After this purchase, Cathie Wood of ARK Invest then distributed her recent purchase into her ARK Innovation ETF, ticker symbol ARKK, and her ARK Next Generation Internet ETF, ticker symbol ARKW. As of right now, Tesla is one of the largest holdings in Cathie Wood's overall portfolio and ETFs, where the allocation in the ARKK ETF sits at around 7.9% according to the portfolio weight. So if you are an investor into Tesla, right now may be a good time to purchase this company because we see smart money absolutely pouring money into this company, especially since Tesla's shares fell below their 200-day moving average. We also see an older book that Donald Trump and Robert Kiyosaki co-authored. And if you don't know, Robert Kiyosaki is very prominent and he's a very good real estate investor, and he's most known for writing a book called Rich Dad, Poor Dad. Although Robert Kiyosaki is widely known for his groundbreaking investment strategies in Rich Dad, Poor Dad in regards to real estate, he also co-authored another less popular book with Donald Trump titled Why We Want You to Be Rich: Two Men, One Message. And this book dives into the details of the importance of financial education and strategic investments, particularly in real estate, and that has been trending lately, so if you haven't already checked that out, go ahead and do that. Since it's earnings season, we should also go over the top stocks to watch right now, which recently brought in earnings. We see JP Morgan, ticker symbol JPM, which recently added 2% to their share price in the pre-market because they beat their overall estimates and guidance from Wall Street, which is fantastic news. We also see shares of Wells Fargo, ticker symbol WFC, which dropped in their share price around 2% ahead of the opening bell. The reason for this is because their quarter 4 profits just did not meet expectations because it was impacted by the FDIC's special assessment on big banks to replenish their insurance funds after last March's regional banking turbulence and a charge for planned staff cuts. What I find interesting is that we also found United Health, ticker symbol UNH, has decreased in their share price around 3% ahead of market open after the healthcare insurance giant actually provided better than expected top and bottom line growth, which beat expectations. This just goes to show you that despite a company beating on their overall revenues and earnings estimates, the company can still drop in their share price due to the market acting irrationally. We also have Qualcomm in the news, and if you recall from a previous video, we saw Cathie Wood of ARK Invest investing heavily into Qualcomm, ticker symbol QCOM, which recently increased in their share price by 2% ahead of pre-market trading. And this is because Citigroup upgraded the stock to a buy rating from a neutral rating, and they also increased their price target up from $110 up to $160. So this is a huge win for Qualcomm investors, and it looks like Cathie Wood was completely right about this company. We also see Boeing, ticker symbol BA, dropping their share price even more due to the fallout of the various news and media that has come out about this company. Over the last week, this company has dropped by 10.6% in their overall share price due to the fallout from their accident involving their 737 MAX 9 aircraft. And if you want more news on that story, go ahead and check out one of our earlier updates. Despite Boeing not performing well, we see other government contractors such as BAE Systems announcing a very prominent delivery of the first production-ready ACV. BAE Systems said on Friday that they delivered the first amphibious combat vehicle command and control variant under the full rate production contract for the United States Marines. According to BAE Systems, 2 of the 4 ACV variants are in production today at their facility over in York, Pennsylvania. And the company also added that they plan to deliver these representative tests for these vehicles in 2025. So this has acted as a phenomenal catalyst for this company, and that's why we see their share price increasing today. In other news, Bank of America earnings were hit by 2 large charges to the bank. Bank of America recorded 2 charges that impacted its fourth quarter earnings very dramatically. The first of these 2 large charges was that Bank of America said that they are going to recognize a net non-cash pre-tax charge of about $1.6 billion in the fourth quarter. However, Bank of America was also hit hard in another aspect because they recorded a $2.1 billion charge from the Federal Deposit Insurance Corporation to help replenish its account after the failures of Silicon Valley and Signature Bank last year. This is something very reminiscent and similar of what's happening over at Wells Fargo. It seems that the FDIC wants to ensure that companies like Bank of America and Wells Fargo will not meet the same fate as Silicon Valley and Signature Bank that we experienced last year, because this adds overall volatility to the economy as well as the stock market. But it's not all bad news, because we see Delta Airlines, ticker symbol DAL, report better than expected fourth quarter and full year earnings and revenue. Delta reported earnings of $1.28 per share, while their revenues increased by 11% to $13.7 billion in the fourth quarter. Now, for the full year, Delta Airlines brought in revenue of $54.7 billion, which represents a 20% revenue growth rate, and their earnings per share surged by 95% up to $6.25. This beat analysts' projections because originally analysts forecasted that they would bring in an EPS of $1.16 per share, but the company actually brought in $1.28 per share, while on the revenue side, they were anticipated to bring in $13.55 billion in revenue, but they actually brought in much more than that, coming in at $13.7 billion worth of revenue. And the same goes for the full year results. Wall Street forecasted earnings of $6.14, even though the company brought in a much higher expectation of $6.25. And similarly, for their revenue, they were anticipated to bring in $54.58 billion, but instead they brought in $54.7 billion. A chief executive from the company even commented by saying, "In 2024, demand for air travel remains strong, and our customer base is in a healthy financial position with travel a top priority." End quote. So this could be a great time to invest into Delta Airlines. Besides Wells Fargo, Bank of America, and a few others, we also saw Citigroup post fourth quarter earnings results. And because of these results, the company's share price fell pretty dramatically. Citi reported a net loss of $1.8 billion, or $1.16 per share. However, this equates to their revenue actually falling for the entire year, because revenue fell by 3% down to $17.4 billion from the original $18 billion, which is not good. And for the entire year, Citi reported net income of $9.2 billion, or $4.04 per share, which is a decrease of 38% from a $14.8 billion or $7 per share back in 2022. So this was a very bad earnings result for Citigroup. And that is going to be the latest news update for today regarding earnings, AI stock news, stock market news, and the latest developments that you need to know about your favorite stocks. Go ahead and annihilate that like button for more videos just like this one. Subscribe if you are new, and I'll see you in the next YT video.